e.l.f. Beauty just lost nearly half its market cap from the 140s down into the mid 70s in a matter of months. That kind of correction turns heads, but is it because the business is completely broken, or is that a type of correction that leads to a rebound opportunity? Today, I'm breaking down what's really going on, what's driving the slump, and whether e.l.f. has the fundamentals to snap back, or is this the start of something worse? e.l.f. Beauty, ticker symbol e.l.f., is a cosmetics and skincare company known for affordable mass market beauty products. They built their brand on value, strong social media presence, and broad distribution because they combine price accessibility with this viral marketing strategy that they've had with the TikTok and all this stuff. So over the years, e.l.f. has expanded into multiple sub brands, and as we can see, it has allowed them to grow quickly over the last couple years. And recently, they acquired a company called Rhodes, which is Hailey Bieber's company, and it has allowed them to strengthen their presence in the skincare and beauty reach as they reach a younger demographic. This strategy has helped them deliver decades of growth and many quarters of rising sales, but recent macroeconomic headwinds, tariff hikes, and changing consumer sentiment have complicated the story, and the stock is now under pressure. As we can see here that by this chart, the stock is down almost 47% in just about a month. So as of today, e.l.f. trades at just around $76 a share, which is down roughly 45% from these highs in the 140s a couple months back. So what has happened? In Maine, the collapse is largely triggered by a negative reaction to the company's most recent quarter and forward guidance. On their Q2 earnings report, which ended September 30th, 2025, they released their earnings, which released that showed this net sales of 343 million, which was below a lot of estimates, which were much higher. The gross margin has also decreased as it came dropped about 165 basis points to 69%, largely due to higher tariff costs and a material headwind, given that a large portion of e.l.f.'s products are imported. Also, the adjusted earnings per share of 68 cents beat expectations, but the top line softness and margin compression has spooked a lot of investors over the last couple months. So more importantly, the full year forecast has kind of gotten lower. So revenue guidance has dropped almost about 100 million, and the adjusted earnings per share has also dropped well past earnings report. And as a result of this softer guidance combined with the tariff driven cost headwinds and signs of cautious consumer spending, e.l.f. shares have cratered and it went down literally 30% in a single session, and it has caused the whole market to re-rate it completely. As we can see here, they have completely reanalyzed their full year outlook, which has made it look very bearish in my opinion, but I'll go deeper into the numbers right now. So let's break down what's still working and where the things are under pressure using the latest data as we've seen over the last couple months. So the net sales increasing 14% to 343 million for the first 6 months of fiscal 2026. Net sales rose to 700 million compared to the same period last year. So the main thing is I see is growth has not stopped. Sales are still increasing, but the momentum appears to be slowing compared to the previous quarter. So the gross margins also have declined now, which was a large cause by imports and product mixes, which have all been offset by the tariff costs. So this is kind of something that's very hard to watch, but the profitability in the company still remains, as you can see by these numbers here, coming in at 66 million and 40 million respectively for the EBITDA and net income. So the margin compression and rising SG&A, which is obviously the marketing and everything, have squeezed the earnings power, but the company is still in a strong position. And as we've seen, they have a lot of cash on hand, as we can see, almost 200 million, but the long-term liability, our debt, has jumped to 831 million, which is up from 156 million in the last year. This rising leverage is something to watch closely because, especially if the macro headwinds worsen, our sales continue to be worse, the this will be a very bad situation for the company. But for now, the cash remains a strong position for them, and it's something that I think they have a very strong suit of. So another part I want to point out is their expected sales, which they decreased, and all these decreases is something that's key risks in the numbers that we're looking at right now and looking for in the future, because we do not know what will happen in the terms of tariffs, a slowdown in consumer spending on beauty products, softer growth in the core business, rising debt, and as I was showing you earlier, this acquisition of Rhode's company is something that have a lot of people have pointed out. They spent almost $1 billion on the acquisition, and a lot of people have been calling it a bad acquisition, and they do not perform well in stores. Personally, some people I've talked to about it have not been very bullish on it and have said it was a bad purchase and a bad indicator for the stock. Me personally, I don't know as much, but I do not see the numbers do not show a good sign. So after the earnings, we've seen in the guidance miss, sentiment among the analysis and investors has turned cautious. Several broker dealers notes lowered their ratings and citing the margin pressure and uncertain conditions. As we can see here, though, the average is still way higher than the current price. The lowest is 100 with the highest at 137 and an average of 121. So all of these are buys or holds in this situation. So obviously, yeah, I think there is an opportunity to be made here. But with the float being almost 98% owned by institutions, it is hard to say whether these are just bullish at analyst estimates just because of their own positions, or if it is also due to the company's underlying performance. So as we've seen, the retail investors have been very divided. Some are treating the drop as an opportunity, especially because the core business still grows and the acquisition could eventually add upside. But as one community note put it, easy hold here, target over $100. So institutional investors seem to be more measured given the increasing debt and cost pressures. Many are waiting, and that's why we've seen the price kind of steady out right now. And we're waiting to see whether future product launches can deliver the growth needed to justify the prior high valuation it had. So in essence, fear and uncertainty have been dominating the stock, and with some slump recently, this I don't see this as a breakdown in the stock though. So from a purely valuation and technical perspective, falling from 130 in this range here all the way down into the 60s puts e.l.f. at a depressed level relative to its prior highs. If we could look at this chart here a little bit closer, we'll clearly see that if we're possibly within a valuation range that could entice long-term buyers when the fundamentals start to stabilize. If e.l.f. can deliver next quarters with decent top-line growth and gross margin recovery, then this could be the recent drop could look like a base for the stock and allow them to reach way higher highs. So the current trading price reflects a much lower forward multiple that's repricing that could work in favor of value-oriented investors, especially given that beauty and cosmetics tend to rebound when consumer spending normalizes, which might be happening here soon, especially once we get this stimulus, which has been promised by Donald Trump, and it should be coming in the next couple months. So however the technicals here alone don't matter, the rebound will need to be fundamental catalysts, which is kind of where I'm positioning myself today. After it has formed this base in the $70 range and bounced up, I'm still being very cautious because as we've seen, e.l.f. Beauty is obviously not dead. The business model still works. There's proven demand and sales are growing, but the profitability obviously is getting squeezed, and the company's acquisition of Rhodes offers a long-term growth lever that could help mitigate softness in the core e.l.f. business if marketed and expanded properly, but I think it hasn't been done so in the last couple months. That said, this is no longer a set and forget type of growth name. It's very high risk, high reward, and if tariff persists, the macro consumer weakness deepens, then I think this could stay at a depressed level for a very long time or move even lower. So if I were building a position now, I would do it in tranches. So I'd buy a position now, I would wait for more news, I would buy more positions to see another piece. If we could see margin improvement or any clear signs of traction, then I would be looking to create more of a headwind here. So some of the key catalysts I am watching is obviously the tariffs. So if U.S.-China trade tensions ease, or e.l.f. successfully diversifies supply chain away from high tariff sourcing, then this could recover the margins very much so. So that would remove one of the biggest overhangs on profitability. Also, I want to watch this performance of Rhodes is one of the huge things because the full impact of the acquisition hasn't played out yet. So if this is able to gain traction, especially via its Sephora market, then it may drive incremental sales outside of the e.l.f. Cosmetics, which is their main line. Also, watch for the new products in the future and viral hits. Consumer spending is going to be crucial to watch as well as we watch in the next coming weeks. Consumer spending is currently soft due to inflation, which could impact demand. But if we could see this move back, it could give cyclical support to e.l.f. and want to watch the company stabilize margins and deliver consistent cash flow because the elevated debt burden becomes less concerning, which could make the value reset more credible. So e.l.f. drop from 130 to 75 is obviously painful for all investors holding or buying in these levels, but it also reflects a brutal re-rating after a streak of high growth and cautious guidance that I think has been understated. So the business obviously is not dead. Sales are rising. The profitability has survived in the core business. Add-ons give it a lot of potential upside. So if key catalysts align, I'm cautiously optimistic and I see a lot of potential in the stock and I might be putting it on my watch list here in the near future. I'd consider building a position in these levels right now and watching closely for signs of margin stabilization on the road's growth before adding more and seeing more out of the company. So let me know what you guys think in the comments. I appreciate all your guys' comments, likes, everything like that. I appreciate if you could subscribe and anything like that. Have a great rest of your day, guys. Peace.